the biggest piece that people miss is that they don't think about the transaction in the context of the buyers, right? But
Okay.
in reality, at the end of the day, the buyers are the ones that ultimately drive a lot of the process, and really understanding how they think about, you know, the purchase price they assign, will be, is crucial to understanding how you can maximize the value of your business.
And we're back for episode 3 of the Profitability Podcast. Today, rounding out with our third musketeer, the last partner in our asynchronous roundtable, Raymond Gong comes to us from, is it Black Diamond Capital?
Yeah. So prior to working as a partner here at Profitability Partners, I previously worked at Black Diamond Capital Management, distressed focused private equity firm buying businesses varying from 500 to $1 billion in revenue, in the $50 million EBITDA range. Prior to doing that, I was working at the family office for the owners of Ashley Furniture, making different acquisitions on their behalf. And now, here at Profitability Partners, we are focused around, making sure your business is really optimized for sale, and you're taking the right steps that you need to be taking really to make sure that you can get that highest possible sale price.
Got it. So, I guess if you don't mind me to asking, what constitutes a distressed asset? And then, like, how does the process of buying or turning one of those things go? I've actually just personally wondered this for a while.
Yeah. So, the distress world, fundamentally, it's really the same as buying any type of business, right? But really, the difference is that just the businesses that we're looking at, they're just in much, they're hairier businesses, firstly. Just, typically what we see is, there's a lot of factors driving the business that are frankly out of your control. But also just the deal itself is hairier, right? So, when we're talking about distress, there's a few different types of distress that exist. There's firstly, the company itself is not doing well. It's in decline. It's either in a sector where the market is really shrinking. You're seeing volumes decline, and, the impact of that volume shrinkage on the business. Another common situation we saw too is, businesses that have problems with their margins, right? For example, after COVID, we saw prices for a lot of raw materials, labor, go up. And, if you're in a thin margin business doing maybe, 10, 15%, a couple percent increase on your costs, that doesn't get passed through, that ends up hurting you a lot. That's like a third. It ends up being a third or half of your EBITDA, depending on, where you are. That's really the first type of distress, which is, fundamental, you know, business operational distress. And the second type of distress you typically see is, it's a business, could be good or bad business, but with balance sheet problems, right? So meaning that they've taken on way too much debt for, their current size, and as a result, they're having trouble, making their debt service. They're having cash flow problems. They're having trouble, paying off both the interest and principal of that debt. And to be honest, most of the time it's the two combined. So, you'll have a business that's doing 10%. Maybe they got squeezed to 5%. So their earnings are, half of what they previously used to be. And then, when you have, maybe they took some debt out and it worked when everything was at 10%, and you get squeezed to 5 all of a sudden. And then, the math doesn't work anymore. Right. So we'd be specialized in, buying those businesses in pretty hairy situations, a lot going on. The advantage really for the private equity buyer here is that, these businesses are in distress, right? They have a timeline. So it allowed us to really pick businesses up for cheap, really fix them up, and then sell them for a much higher price. And that's, actually one of the reasons why we got into Profitability Partners is like a lot of the work that we're doing, optimizing these businesses, really doing a full turnaround of the company. These things are the exact same steps that, essentially what we're doing now with businesses to get them optimized for sale, even if they're not, in as hairy of a situation as some of the companies that we're dealing with in the past.
I feel like we've had a couple that have been in some fairly rough spots. That does segue really nicely into the follow-up question here. So, like, if a private equity firm picks up one of these companies that's gotten themselves in over their head and then just kept digging that hole deeper, Obviously, enough, you've got some resources at your disposal to fix this, right? You can usually throw money or capital. You can convert things over. You can take a loss for a few years to fix it if you have to. How do you fix that problem as an owner operator if you don't have the additional resources coming in? Like, what is it that profitability does for people in those scenarios?
Yeah, absolutely. Like you mentioned, George, some of it is, recapitalization, refinancing out the debt. But to be honest, in most situations, that's not what that's not really what we were playing in, right? Most of these are fundamental business turnarounds where, we're going in, we're, cutting some costs down, we're changing the way that, certain contracts or, the certain ways business is being done to fundamentally, improve the operations and improve the cash flow. Because you think about it, right? If you're just refinancing the business, you're not really making any money at the end of the day. You're because all that refinancing is coming from you, right? It's coming from you, so it's not profitable. So really, the core of the work is around really the fundamental business operations. That's how we underwrite it because in most situations, we're not buying business, you know, that's losing money. We might have to infuse it with capital just in a very short term, but it's not like, we're waiting 3 years for this thing to get profitable and we're funding it the whole time.
Right.
It's really,
So
what I
hypothetically,
what I'd say is that go ahead, George.
oh no, that's
But
your
yeah, what I was just saying was that the stress is really a mechanism for acquisition is essentially what it is. It allows you to get in at the right price.
right. And so obviously, if our goal now is to help people avoid that exact scenario. So now the question becomes, if somebody comes to you and they're like, let's say they've got an e-com business of some sort or something similar, and they've been growing for a while post COVID, and then like the last year or two, it's been like flat down. China tariffs have hit them or something to that effect. Do you have a framework for how you would approach that business, for like what you would do for them, or how you would approach trying to turn them around and get them ready to either pull out and exit or get it back on track?
Yes, absolutely. What I'd say in these kinds of situations, really always the first step is you really need to look at your numbers and understand exactly what is going on and why things are happening. That's always the number one step because every turnaround looks really different, right? In terms of the steps that you're taking. There's no, you know, one playbook or one guide is, oh, we come in, we just cut all the costs, and that's how we make money. Really, the key to doing all of this in the first place is making sure that you know exactly what is going on, what is the source of distress, exactly what the problem is before you try to fix it, if that makes sense. Because if you don't identify that problem and you take a bunch of actions which aren't related to the problem, that could potentially put you in a even worse situation. So an example, just to give you an example with
Please.
the e-commerce is like, for example, if your costs are going up, um, that's something that's really, out of your control. But the question is really, how does that cost going up impact your business, right? And its profitability. Of course, your profitability is going to go down, but is the problem that, okay, with this increase of cost, versus how much you're paying to acquire the customer, you can't support this level of sales volume and you actually need to be selling less product to drive your customer acquisition costs down? Or is it, maybe you've had too much overhead for where you are, with your business at your current size, or, even at the current volume that you're running at, and the cost going up is kind of it's the straw that broke the camel's back, right? So like that's just an example of it's like it can be a bunch of different things, and actually the distress is just something that really it brings a situation that probably wasn't good in the first place to light, because a lot of businesses, they can go into a tough situation, they can go into a environment where prices are increasing, and they can still survive, they can still make it. The best businesses, they actually thrive in those environments because all their competitors are, they're struggling, right? They're struggling. And then, these big guys, they end up eating their lunch. And that's one of the advantages of being, one of the bigger players in the market, having that first mover advantage. But really, that's what I'd say is, kind of the playbook is like, if the market's turning against you and you're in a situation where, you're struggling, right? It's often because it's often because there's actually something else going wrong. So that's why that diagnostic process is always that first step, knowing your numbers. And from there, everything else will logically flow.
Got it. So if I'm understanding correctly, and if I was going to summarize this, hypothetically in the scenario I provided, something like tariffs, it's a macro event, which means it's hurting you about the same as all of your other competitors. So whenever you have an externality that starts hurting you, the secret is to dial everything else in faster and better than everyone else around you, and then collect market share from people who are too slow to react on everything else. So if you can't fix it, fix everything else, and then make up the difference from people that are not doing that. That makes a lot of sense.
Big, absolutely. And because, when you look at a market as a whole, right, there are very few situations where you see that the market's never going to really disappear if you're playing in a mature industry, right? For example, plumbing services, you're always going to have plumbing. There's always going to be someone
I
there to do
certainly hope
plumbing.
so.
Yeah, you just need to be the guy who's operating the best, and you'll be fine. You'll make it through unless the industry entirely just collapses, which it happens, but not as much as you think in a very mature industry. So in that case, it's all about just being the winner. And then, once things pick up, you're well positioned. You got that market share. You're ready to grow.
Makes sense. So if you're an owner operator, again, it sounds like the takeaway here is anytime you start coming up on a distress or like a macro sort of distress scenario, the secret is just being the fastest to react and knowing exactly where you can or can't pull levers. You want to talk through a bit like how does one go about doing that? Or I guess this is going to segue very nicely into like what does profitability do that gives you exactly that? Since I kind of know the answer to part of this.
Yeah, absolutely. Right. And, it's all about knowing really kind of, firstly, your costs, understanding, this is an analysis I do with every single one of my customers, but understanding what costs are variable and what costs are fixed, right? Because when you're in a distress situation, when you're in a downturn situation, inevitably what will occur is that your volume will go down. So we need to understand what costs are going to scale down as that volume decreases. And essentially, for every additional unit or, job that you're selling, how much incremental profit you make from that one job, right? And then we can calculate, as that scales down, how much profit you're bringing in so you can cover your overhead. And that overhead is really that second piece, is understanding like what are your true fixed costs, and are your fixed costs appropriate for the current level of scale that you're operating at. Because this is the number one, I'd say, from working at Profitability Partners, working with all of our clients. This is where people get into trouble, is when they do see a situation where their revenue's declining, their volume's declining, it's not cutting back as much as they should be when they start to see the sales going, right? But in order to do that, you need to understand, okay, there's some costs you really can't cut, which is those variable ones. That's just, part of the operation of the business. Then there's the overhead. There is just to summarize, there is a right level of overhead for every level of scale for each business.
Got it. So how do we determine that level of overhead and or I guess which costs of the fixed ones that we can triage would you say in a global downturn scenario? Like 'cause this is actually probably fairly poignant. We are probably heading into a macro downturn for a lot of industries. So like in a macro downturn scenario, which costs would you say you start targeting initially? Like, and I get that each case is unique, but which ones are most frequently we can cut this, it's not going to hurt us.
Yeah, absolutely. There's certainly like a priority in which you want to be doing things, because there are some costs like, you know, the way I think about it is I want to start from the least operationally important items to the most operationally important items, right? There's some costs where you're literally just trimming the fat and it's not going to impact the day to day of the business at all. And that's where you want to start. And that's where I'm talking about really like overhead operational expenses. For example, more recent clients, we're looking at phone expenses, how they spend way, that when you're growing like that, some of that stuff it goes by you, right? You don't even notice it and it doesn't really hurt you. But there are people spending way too much just on their phone, their phones, right? Like thousands of dollars, tens of, a recent client of mine, tens of thousands, $20,000, $30,000 just on phone bills. Looking at, um the softwares, right? Software is another big one. You sign up for, a chat GBT subscription, and, someone signed up for 10 of them and you forget to cancel them, right? And they rebill every month. So looking at really those recurring overhead costs that firstly it just has nothing really to do with, if you're providing a plumbing service, it has nothing to do with you getting dispatched, going to a person's house, fixing things up, and then, coming back to where you need to be, right? Those are the places where you always want to start because it's just gonna not really have an impact on the core operations. I'd say the second area where you want to start looking is really, looking at kind of like a head count. That's an important area. When I say head count, specifically outside of really the people who are fundamentally doing the work that your business provides, right? So really kind of, some staff, maybe kind of in the back office. That's another potential opportunity. And then we want to work our way up. So before we even get into, the cost of goods sold and everything, another one, you know, that we recently identified for a couple of our clients is like, real estate, right? Especially if you're in a very real estate intensive industry, making sure you're efficiently utilizing your space. That was a really big opportunity. We had a client that was paying 60 grand a month for an office that they only used half the space for, right? So the goal here is like we're gonna lease half of that out. It's 30K per month, 360,000 to the bottom line annually. And you sell for 10x multiple. That's 3.6 million right there, of value creation. So that's kind of really the non-operational items. Then, where things get a little more hairy, and this is where things are, we start to see a little more bespoke. This stuff requires a lot more analysis to feel comfortable pulling off. There's a little bit of risk to it, is when we start looking at really the cost of goods sold, right?
Okay.
Cost of goods sold and then pricing. So looking at, what it takes for you to actually be able to do the work that you're providing as a service, or, for the product that you're selling. So let's talk about, e-commerce for an example. Let's say you're selling candy bars, right? Okay, where can I kind of save money on my shipping? Where can I save money on, my wrappers, on the product? Am I using the right suppliers, right? The supplier that can get me the right price with the same quality. Those things, that there's a lot more work that goes into that. And that's kind of, what we call, like, it's not so much low-hanging fruit, but that is opportunity for you within your business. And then the final area is also to pricing, right? So making sure you're pricing everything where things need to be. The unit economics, basically the math that goes into, okay, I sell one unit. How much am I getting? How much am I paying to be able to sell that unit? Plus, my overhead. How does that ultimately pencil out at my current level of scale? Are those numbers right, for me to be able to remain profitable? So that's generally at a high level what that process looks like.
Got it. That makes sense. And so was it tiers one and two are the sorts of things where, like, given about 90 days with the company, you can kind of pick out here your low hanging fruit. I can chop out those subscriptions. We can move that real estate, or we can lease that real estate out. And then maybe in days 90 through, I guess, 180, it'd be your, all right, here's your exact unit level economics. Here are your COGS associated with them. Here are the areas where you have wiggle room in the COGS. So really, like within 6 months, you should be able to fix a lot of the distressed characteristics, or at least all of the controllable levers within a distressed situation. Now you
Yeah,
mentioned
absolutely.
Now, you mentioned at one point the if you could manage to lease out half of that real estate space, you'd get 30K per month, comes out to 360 per year, and then the 10x multiple at exit. And so I guess, yeah, we've got into it on a couple of the previous episodes, but this is a finance podcast, which means that I doubt anyone's going to be watching through the whole thing from end to end unless you're on a really long car trip. But let's talk through what that 10x multiple is, where it comes into effect, and basically why it is that you're getting that it's so important to start adding to that bottom, especially since you're one of the more M&A focused of the partners. You want to talk through from beginning to end, basically, how does this process look? What are the most important variables going into it? And then how does it come out in the wash at the end of it?
Yeah, absolutely. All of basically the whole sale process. I think the biggest piece that people miss is that they don't think about the transaction in the context of the buyers, right? But in reality, at the end of the day, the buyers are the ones that ultimately drive a lot of the process, and really understanding how they think about, you know, the purchase price they assign, is crucial to understanding how you can maximize the value of your business, if that makes sense. You know, just to speak in the context of like a private equity buyer, or really any buyer, the framework really is the same. Is that at the end of the day, people are buying your business because they want to make money, right? That's their goal. Specifically in private equity, you have investors who have given you a pool of funds, which you use to then buy companies, optimize them, and then sell them for more money. So the idea is that the way the buyers come to the valuation and just the value of a company is by fundamentally understanding what they can pay, what's the maximum price a private equity buyer can pay you and still make the returns that they promise to their investors. Right. So the typical benchmark number in the private equity industry is around 15 to 20% rate of return. So every year, let's say I have $100, I'm going to make, my goal is to make 15 on that $100. Right. And essentially what they do is they calculate all the optimization opportunities within your business. They calculate what they think they can sell the business for. When they go to their own exit, and they use really kind of the risk of the industry, the size of the business, and a bunch of different factors to calculate what they can pay you and still make money at the end of the day. So that's fundamentally what's going on in the back of at the back of their heads is really, "Oh, yeah, Bob looking to sell his company. If I pay him 10 million, I think I can flip this for 20 over a 5-year period. Okay, 2x over 5 years. I'm getting a 15% return. This number pencils out for me." That's really, at the end of the day, just to keep it very simple, that's what that process looks like.
So then I guess we're talking, they think they can sell it for 20% or for 20 million, you're starting at 10, and they're evaluating based off, you mentioned risk factors and then missing efficiencies. From that perspective, it sounds like it would make more sense to run your business inefficiently so that when PE looks at it, it says, yes, we can grow this faster because I just have to fix all the dumb stuff you've been doing.
Well, here's the thing you're missing on that, George, is that putting all these things together, it's risky, right? Because these are all we're talking all about hypotheticals that have yet to be done. So the idea is like if you manage to do this work yourself, and that EBITDA, those earnings are present and there, they can feel comfortable paying you based on actually what you have in place right now, right? So even if you squeeze those opportunities out, the other way to think about it too is like, if your business is operating more efficiently, your business is, in theory, less risky, right? They have a lower chance of, losing money. And the other side of it too is you have to think about like who are they selling to at the end of the day, right? When you go upstream to the bigger, the way this whole thing works, it's almost like a giant pyramid, especially in the private equity industry, where you start at a $1 million company, you grow it to $10 million, and then there's someone else who's going to buy it, probably another private equity group, right? And the thing is, like that private equity group who's above you, they're willing to pay slightly more, right? Instead of maybe 5 times, they're willing to pay you 8 times, and that's what a lot of private equity guys they're banking on is like, I'm going to have a bigger fish upstream. This asset, it's going to be a higher quality business. It's going to be a bigger business. They can pay me a higher multiple on it. They got more money, so, I might buy it at 5x. I'm going to flip it at 7x. We're going to try to grow the EBITDA along the way, right? And that's how they get they make their money. And now these private equity guys, they're paying up a ton. This industry's gotten so competitive. And, the idea now is like they're really stretching because they're trying to pay the most that they can to the seller, and then they're underwriting their deal based on the fact that okay, someone else is going to pay me on a higher, not just at a higher EBITDA, but on a higher multiple, right? So they're assuming a lot of deal risk when they do that. But that's how they envision themselves in their head how they're going to make money at the end of the day.
That makes sense. And actually, let's dig into because this is going to look like a black box to most owner operators, and honestly, myself included, since I come from the other side of this. Right, I'm former founder rather
Mhm.
than former PE. So Owner sells to PE. PE gives them some multiple for their business and says this is worth 5 to 8 times what you're making currently. And to a certain extent, like we process that, all right, what he's going to do probably is make something more efficient, add more capital to it, maybe roll it in with some other businesses, and it's going to grow somehow. We assume that they know how they're going to grow it, but we don't actually know what they're doing. So like after PE scoops up a business, what happens like days 1 through, I don't know, 180 and then onwards? Like what's the actual process look like for integrating, rolling up, and then getting that efficiency out of
Yeah. So to answer that question, it depends on the situation. So typically you see two situations, which is a standalone deal. So they're buying your business as really a platform to acquire other businesses. And this is talking about roll-ups, right? These are, we're talking about companies that are using, that are buying other businesses and you're going to get combined, right? But, just talking about the standalone business, this is typically a lot more risky for the private equity buyer. And the way that works is you come in, they buy the business, right? Typically they'll come in with a plan, a 100-day plan or, 180-day plan. And before they purchase the company, they're going to have an idea of, okay, I see like these are the inefficiencies that I'm seeing within the business. If I can execute on this, maybe I can add another 5% on my margin, right? To my EBITDA. So they're like, okay, they buy the company, we're going to get to work. We're going to maybe, we're going to change some things around, restructure some contracts, maybe cut out some overhead. And then, our goal, the way we underwrote it is like, okay, after a year, instead of, doing 1 million of profit annually, we're doing maybe, 1.3, right? And then, they keep working on it. They're hoping, the market grows. There's some other tailwinds, pushing the business upwards. And then, at the end of the day, they're like, at that bigger size, if they can sell at a higher multiple, let's say you go from $1 million of EBITDA to, 1.3, but instead of selling at 5x, which you bought it at, you sell at 7x, you get that multiplicative effect. And that's what gets you that ultimate return, in addition to the cash flow that you're collecting on the business in the meantime. Because the business, of course, making money along the way. The second playbook is really, if they already have a company, this is typically what you'll see in a lot of industries like a home services. You'll see this in professional services as well, but they'll have a bigger company, like let's say this company is doing $20 million of profit already. They have everything, everything lined up, everything set up. And they basically go out and they buy up these, $1 million EBITDA companies. And all they do is they just merge it into that big company. And then, they can chop out a lot of costs. They can chop out, they can chop out their overhead. Maybe they can improve some processes. They can cross sell to their customers. So there's a lot of synergies that go there, which allows you to take down your effective purchase price, right? Like if you think about it, like let's say I bought a company doing $1 million EBITDA for 5 times, right? But let's say, I can save 10% on my margin because of all of these synergies. And let's say that adds, depending on the margin profile of the business, that could be like 500K, which falls at bottom line. So instead of buying it really at like, 5 times, I actually bought it on, let's say $5 million purchase price. I really bought it at, 5 million divided by 1.5, which is a lot lower than 5x. Right. So
right?
with
You're close
that,
to like a
I
3x.
could, yeah, you're close to a 3x, and what that implies is you're making a 30% return just from the cash flow of the business after all those synergies. And that gets you to the hurdle, right? So it's a lot
It's your
safer deal. It's a lot safer deal for the buyers compared to, the standalone deal where you need to roll up your sleeves. You need to take a lot of operational risk to get these improvements that, you're not fully sure about whether you can even execute.
Got it. That makes it feel like the tuck-ins would be less risky than the standalones, but usually the standalones get the higher multiplier when they're buying them. Is it just because it's more competitive?
It's actually the opposite. So typically
Oh, okay.
for a roll up, you'll see actually a strategic buyer, right? So there's a big universe of buyers out there. We can commonly classify them really into two types of buyers. Maybe three, right? But in the context of this discussion, we have two, which is the financial buyer. Often, just to not confuse things, this is like a private equity group, buying a standalone company, right? And then there's a strategic buyer, which is the company that's operating already in your industry. Technically, it's not the private equity group buying you. Keep in mind, it's the strategic. It's actually their company they already own that's purchasing you. So we put them under strategic buyers for now. Typically, the strategic buyers will be able to pay the most for your business because they're the ones who have the highest chance of making the deal work, right? Even by paying a higher price because they have those synergies in place.
Okay, so that
And
makes
just to
sense.
give you
You
an
get a higher
example,
multiplier.
to give you an example, right? Let's just talk about the HVAC business. With the HVAC business, they buy the business. They feel comfortable. Hey, I can add, if I'm doing $1 million EBITDA, I feel really good about adding, that 500K because I already know like I can chop all these overhead out. Whereas, with the standalone, I'm gonna have to keep the overhead. That essentially, drives a lot of that return there, and therefore, allows them to pay more because at the end of the day, if you want to sell for the highest price possible, you want to go through a competitive auction process where people are bidding against each other.
Yeah, that makes a ton of sense. I'm doing something similar to this with a plumbing company and a vet clinic right now, where in both cases, if I can roll them in with my existing one, the cross sell potential makes it significantly more valuable. So I don't really mind overpaying so long as it's in the right location and has the right demographics and service offerings for me to match up to.
Yeah.
I will note that makes the math really hard. All right, we're going to be running a little short on time coming up at the end of this. So I guess let's pivot a little bit. Uh, any particularly notable or cool client accomplishments that you want to talk about for a minute? Like most exciting things that you've done some recently.
Yeah, absolutely. I think one of the more interesting ones, it's a relatively recent one, is a plumbing company we started working with. Actually pretty well run company in terms of, the core operations. They were pretty much at kind of, what you would expect within the industry in terms of, if you look at their gross profits, right? So this is talking about like, okay, how much how much am I charging my customer? How much is it costing for me to do the work? And then, what am I making at the end of the day? They're about 50%. Um, but what was quite interesting is, this business scaled pretty rapidly over a short period of time. So their overhead was super bloated, right? And they were at like 7.5% on a net basis. But just by chopping the overhead, this one was like probably one of the easiest like low hanging fruit opportunities. Um, you know, kind of for of all the clients that pretty much I've seen is like, hey, we just figure out how to optimize your square footage. We cut down a bunch of different overhead costs. There's a lot of stuff that they just did not need to be spending money on, and we got to basically an additional, I think, $1.3 million of EBITDA, which actually was a doubling of their EBITDA. They're a very big company. They're double digit millions, closer to 20 to 30 range. So, that's how we could get them from 7.5 all the way to 15 on that size. You can imagine that's a pretty big amount. And then, when you think about the sale price, right? These kind of companies at this scale in that industry, they're going for 10x. So it's you add a million to the bottom line, that's 10 million to your sales value. And it's all because you chopped out ChatGPT, you leased out your space. This is the example I was citing is, you know,
Okay.
you have you have 30K you're spending on just office space that you're not really using, right? 30K per month is 360 per year. And you multiply by 10x, that's $3.6 million you add to your sale price just by subletting out half your space.
And that again is completely excluding the like reinvestment of that profit into something useful to grow during that time period.
Yeah.
Right.
Yeah,
Yeah.
exactly.
Yeah.
You grow your team more,
Yeah.
you spend some more on advertising, you put that money to work, that's going to be even more profit for you. So, and even more, at your sale.
That is a pretty good ROI for a little CFO. And how long did it take you to do that?
To be honest, for this one, we figured it out in 30 to 60 days. Uh, I'd say 60 days just to be conservative. Came in, this is a play, but I mean, this is really just a classic vanilla, you know, overhead cost chop. We talked about that scale, right? The scale of what's the easiest, lowest hanging fruit to the highest hanging fruit. We started relatively recently working with these guys, but even just in that low hanging fruit tranche, there's a lot of opportunity. And like we haven't even worked all our way up. And with what we found just in the low hanging fruit tranche, that's already that's already 2x your previous EBITDA, right? So it's
We
not a bad return.
we might be underbilling a bit. That whole thing where you
Yeah.
price to what you're getting your customers, we're not good about that apparently.
Yeah. Yeah. I mean, for that one, I mean, they got a good deal, but I think those guys are going to get amazing results. And
That's exciting.
there's more to do. Think about it. Like those guys are sophisticated, right? Those guys are running a pretty big operation. It's not easy to get to that level of scale. So, you think of a smaller business owner, it might not be overhead, right? You're running a smaller business. You might not have as much overhead. It's easier to track, but there's certainly other things going on as we think about that pyramid.
Right. And though in theory, the lower hanging fruit might just be the product of being too busy to pay attention to something at that point. Like if you're a smaller business, the owner doesn't have time to be going through a lot of the numbers or a lot of the various reports coming in to keep track of every single metric as it moves. And so it is even more likely at a smaller scale that there are more low hanging fruit to be found there. That tracks.
Yeah. Yep.
Um,
Absolutely.
all right. Hard pivot for a closing comment. What's your thought on current state of the industry, macroeconomic, and just the state of like the buying or M&A industry right now? Where do you think we're going, and where do you think we are right now?
Yeah, I mean, I'd say, the huge thing that, both the M&A market, but also just the economy as a whole is hinging on right now is really the interest rate environment, right? A couple of years ago, the interest rates were going up, right? We had this kind of hot period post COVID where interest rates had to get slashed just to stimulate the economy. Things got very, very hot from a market perspective. And then, of course, we have to raise those rates back up to kind of, equib to make things a little more kind of balanced, right? So what's happening right now is, the Federal Reserve has been dropping interest rates, which, of course, is done with the goal of stimulating the economy. But the other side of it is you think about like how do buyers finance? Because at the end of the day, a lot of this is it's driven by buyer demand, right? How do the
Okay.
buyers finance a deal? A lot of times they're not paying, you know, pretty much like all buyers, like, a majority of them are not paying all in cash, right? It's not like they got 10 million in the bank. I'm going to just send that to you. I'm going to, finance it, or I'm going to, that's going to be it. And then I'm not doing anything else. A lot of what drives how the numbers work. Cause remember, keep in mind, we're thinking about what do they need to do to be able to hit the 15-20% return, right? Is that the buyers are borrowing a lot of money. They'll finance half the deal with bank debt or some other financing source. And the idea is like, okay, if I can finance half the deal, at a relatively low interest rate, and I only need to put half the capital in, the way I'm calculating my return is based on the amount of money that I put in, not necessarily the amount of money that the bank put in,
Got it.
right? So I can
Minus
put half the
minus the
money
interest
in
rate.
and I can make the same amount of money, on the deal as a whole. Like let's say this is a deal that, that the 10 million purchase price, I sell it at 20. 20 is what I'm getting net. Basically that incremental 10 that I'm making in terms of return, that's accruing all to that money I put in, right? The bank is only going to get paid, 4%, 5%, whatever. And, all that excess is going to come to me. And that's what really juices the deal in terms of, the ROI, the investment rate of return that these buyers are getting.
Okay. So current state, the interest rates are coming down kind of slowly, but they're coming down. So where do we see this going? You think it's just gonna be a hotter market soon?
Yeah, I mean, look, with what's going on, in the with the interest rates, the dropping of the interest rates will definitely help, I'd say. I mean, of course, there's also a lot of other things going on, right? If there's a war, that's going to hurt the market. Of course, the tariffs have had an impact as well. There's some uncertainty. So really, I'd say the drivers of M&A generally is certainty around the economy, because also the buyers also need to think about how the economy is doing, because that's going to impact their return on the flip side of this, right? But it's really, financing, like how easy is it to secure financing? At what interest rate am I securing that at? That's going down right now, thanks to the Federal Reserve. How good do I feel about the economic outlook once I buy the company? And then, what do I think I'm going to sell at? Because that's another question too, is, hey, On the other side, someone else is doing the same calculation, right? So, when it's time for me to exit as a buyer, do I think someone's gonna be able to pay more than I paid for it? So that goes into the equation as well. So those are the things I'd say really like drive it. And then, of course, it also depends, like small business, bigger business. I'd say small business is actually, it's a little more consistent because it's just, there's so many more companies right out there. There's so many more deals being done versus we're talking about, okay, someone buys AT&T. There's only so many of those deals going on. I'd say actually the small business M&A space is a little more consistent than what you'd see when you go upstream in terms of size.
Okay. So like the old school Switzerland approach, where it was just peace through ongoing small amounts of chaos that offset each other.
Yeah.
So then I guess from a slightly more niched down perspective, if we say that a rising tide probably lifts all ships, so there's a good chance that the buying market is going to heat up as interest rates continue to decline. Which industries in particular do you think are going to be doing well given what's coming?
Yeah, so in terms of, the industries that'll be doing well, I mean, those are the industries where, as a rule of thumb, this is, not just, in the short term here, but these are industries that are relatively stable in terms of, end market demand, right? So like one trend we see is like a lot of blue collar, a lot of home service businesses. There's a ton of demand because, firstly, plumbing, HVAC, that's never going to go away. Like your toilet breaks, your HVAC unit breaks. For example, I live in Florida, right? I'm not going to go a week without, a non-functioning HVAC, especially in the summer. That's literally like that's a safety risk, right? Whereas, some other industries where you're selling things that are, not as essential, or more like, this is less relevant in the context of small business, but you think of like luxury, that's a little more like cyclical, right? That's like, no one's buying a Louis Vuitton bag when, you're in 2008 recession.
You say
Those are a
that.
little, generally, those are generally what you think of like, cyclicality. So like typically the non-cyclical industries are, have the most private equity activity because at the end of the day, these buyers are looking for companies that they feel comfortable putting debt on, that they feel good about the EBITDA, staying flat or growing to be able to make their returns, right? So when the
This
interest rates go down, when financing goes down, that's one of the biggest factors that goes into, how this whole math is being calculated. And you typically see that, they'll be able to raise a little more money. Their investors are looking in place to put their capital. So you'll start to see like a pickup of activity from that side.
That makes perfect sense. Tying directly back to what you just mentioned, one of the big considerations for buyers is, will there still be a market for the thing that I bought in the 5 years or so that it's going to take me to grow it? And if you go for a non cyclical business, the answer is usually pretty confidently, yeah, there will.
Yeah, exactly.
Awesome.
Exactly.
Well, I think we're coming up on time. Anything else that I wish I'd asked you about or want to add for the audience?
No, I think from my side, we touched on a lot of items today. I want to thank everyone who's watching the podcast. Hope this was informative, and if you ever have any questions, please feel free to reach out to the team, and we can get those questions addressed for you.
That's again, profitability partners. There'll be a link to page, email addresses, and any other form of contact information I can reasonably consider to include. We'll go in there. Other than that, this rounds out our asynchronous partner roundtable. I think our next episode will probably bring everybody to the table at once and just have them debate some current events topics and see if I can get them to disagree on anything funny. And then we're going to start checking in with customers, brokers, and other folks in the industry. So feel free to submit requests for people you'd like to hear their opinion on things. Thanks for joining us.
Yeah. Thank you.
Take it easy,
Thank you
Raymond.
very much, George. Have a good one.
Later, buddy.